Good evening, everyone. Really nice to greet you all, and I am really pleased to start this seminar. We have quite a varied program, which I hope you're going to enjoy, and I'll actually just sort of tell you a little bit about the program itself. So we're just going to upload the various pictures, so if the screen looks a bit funny, just bear with us. Okay, here we go. So tonight's topic, we're talking about retirement myths and realities and whether you are ready for retirement. And so tonight's program, you can see here, we're going to look at the history, particularly centered around the state pension scheme, some of the numbers, what's been going on. You're going to have to listen very closely because we're going to have a quick quiz on what that is, just so this isn't the usual webinar where you're not involved. We'll try and get you involved, and then we're going to look at the main problems in retirement planning and why is it important to have a financial consultant, a little bit about GPI, and then I'm going to introduce our asset manager, who are called Mithril, and the managing director called Soma Thermwin. And he'll be doing his own talk about what the current market situation is. So let's sort of move forward and look at some of these questions. But first of all, I'd like to ask you a question. Can you tell me where you are? If you just write in the little box and tell me where you are, so I can get a little bit of a gauge as to who I'm talking to, or at least where you are currently. Thank you. Okay, great. So as obviously we're spread around a little bit, all in Europe so far. No one further afield, but that's fine. Thank you for doing that. So I want to move into looking at some of first of all, the state pension schemes, and give you a little bit of a history about it. Believe it or not, Germany started the very, very first state pension scheme, and that was in 1889. And it was Chancellor Otto von Bismarck. Now, the actual pension scheme started at the age of 70. It's obviously come down since then. And in actual fact, interesting, it's like a little bit of a yo-yo. It's come down since then, and we see most countries increasing their pension date back upwards. However, there is one big difference. I bet no one can guess what the life expectancy was in Germany in 1889. It was actually 43. So Chancellor von Bismarck putting the start date of being age 70, there wasn't a lot of people that were going to benefit from that. Anyway, as you see from there, the United Kingdom followed the German starting in terms of their pension, and in fact from there many countries modelled their pension scheme on the UK scheme, and it was certainly the best system at the time. So I just want to look at some of those countries that have a particularly strong pension scheme. You've got on the best, you've got Denmark, the Netherlands, and Israel. Denmark, very strong social security, good funding, and certainly a very strong regulatory network. The Netherlands, they're again well funded, has a high level of participation. Israel, high funding again, long-term planning and strong regulation. So you can see with the best, there's a certain commonality between that. And similarly, with the worst performing pensions or the worst pensions globally, you've got Venezuela, low funding, poor governance, inadequate benefits. And you can say this are similar for Turkey and Thailand. Very much underfunded, poor performance, not very good benefits. You may remember several weeks ago, there was quite a crisis in France, which really mirrored the general crisis for state pension schemes. So in France, they increased the retirement age, the state pension age from 62 to 64. Now that's on top of the fact, as you see, that the French pension scheme is quite a difficult scheme. It's not as easy as some of the others. They have multiple regimes, each of the different regions in France, and I think there are 14 or 18 different regions in France have different rules. Most people are very confused by them, particularly, of course, you get the labour force moving from one region to another, and they're not sure where they are. Anyway, there was an uproar with the increase in age from 62 to 64. Also, of course, the French government talking about increasing individual contributions to the pension, particularly, for high earners, and merging these different regimes. So it's going to be quite a complex jiggle with exactly what's happened in the French scheme. On top of that, there are other difficulties in terms of the state schemes. One of the biggest impacts that we see is the rising life expectancy. I talked about life expectancy in 1889 in Germany before. Life expectancy has risen substantially since then. I'm sure you're all well aware of that. Over the past 30 years, life expectancy and the birth in the UK has increased from 75 to 82. We're going to look at a chart in the middle in the moment that really highlights this with other countries as well. In fact, the global life expectancy is now 74.6, which has increased substantially even in the last 7 years. Okay, so let's look at some of the others. So life expectancy is having a big impact on pensions, state pension schemes. Another contributing factor is demographics and the imbalance between the Western countries lowering birth rates, and that's the experience there. Why does that matter? Because fewer children are growing up to be part of the workforce, and it's the workforce that actually fund those who are in retirement. So you can see from the data we've got here, the average fertility rate used to be or needs to be 2.1, where in actual fact, in the 35 members in the OECD, it's only 1.7. And in fact, some of the countries you got there, Germany, Japan, Spain, actually, have an even lower rate of 1.5. This has a big impact. So you've got these two big impacts on the state pension schemes. As a result of these, there's a dramatic increase in the cost of these schemes, and also the needs for funding. So governments have come under very severe pressure because of these obligations, because older people will look to governments to provide for them. And so this becomes a real knock-on effect, and meaning that private pensions become more and more important. And here we're looking at some of the life expectancies and also the increase in current age. So if you look there, the UK, current retirement age 64, 65, with the intention of increasing to 68. Now I know, because I'm sort of in this bracket, that the UK have actually now increased to age 67. So Germany, 65, looking at going to 67. France, as you've seen, has actually moved from 62 to 64. And with likelihood of increasing to 67. You can see all these countries, Italy there, looking at going even longer. The reason for this is, as I've said, the funding of this is becoming too expensive, and life expectancy, the length of time that governments are having to pay for pensions, is extending. Again, here we have, it's the same picture all the way through. I won't go through each individual one. It's the same picture all the way through. The countries are having to increase the retirement age. And we think that is a pattern. Okay, so I'm going to do a little link in the box, which is a quiz. So we'll just stop for a couple of minutes and allow you to do this quiz, and there are going to be prizes for the winner. Okay, I'll give you a couple more minutes. Okay, last 30 seconds. Okay, we'll go back to the just before we move on. I put, just before we started, I jotted down some other interesting facts on life expectancy. I find it quite fascinating. Believe it or not, Hong Kong has the highest life expectancy in the world. You wouldn't have thought Hong Kong would be that place, of 85.29 for males. Females is in the 90s. The UK, as we've said before, 81.77, so virtually 82. The lowest country in the world is Nigeria, with a life expectancy of 55.75. In terms of Europe, these figures were actually done before the war. So Ukraine actually has the lowest of 72.5, and Russia not far behind on 72.99, so similar-ish there. Those figures were taken before the war, obviously. So they're quite fascinating in terms of how life expectancy is moving forward and the impact that has. Okay, so in terms of, we've looked at the state pension side. I want to look at actually more on the personal side. And when I was thinking about this today, I kind of, had various reasons, what are the problems with retirement planning and all this. And actually, when I really kept unpeeling the onion, it came down to two things. The first one is perception. Now, I'm going to take some of you back. Obviously, I haven't asked all your ages in terms of what the average age is of people listening. But I remember this very vividly. I am actually from Liverpool, So this sort of next song, which probably many of you know, it's a Beatles song, When I'm 64. It captures the sentiment and to do with perception of retirement very easy. When I get older, losing my hair, many years from now, will you still be sending me your Valentine? Birthday greetings, bottle of wine. I've got to be careful not to break into song here. It's careful for you all out there. If I've been out till 2:45, would you lock the door? Will you still need me? Will you still feed me when I'm 64? And you might think, oh, they were strange lyrics. But I remember when that song was first out. And actually, at the time, being old, being 64 was old. And you're actually infirmed, and you thought, well, your life's towards its end. You were winding down. Your ambitions and dreams will all take a back seat. However, now that has changed drastically. Your life dreams, you could say, well, mine haven't sort of taken a back seat. I've still got a lot of dreams. This is actually the second verse, which really sort of highlights what I'm saying. Every summer we can rent a cottage in the Isle of Wight. If it's not too dear, we shall scrimp and save. Grandchildren on your knee, Vera, Chuck and Dave. So we've got this little video that we're going to play for you in terms of retirement. It's never too easy to plan. Okay, thank you. So it's very easy. If you looked at that video and saw all the pictures, you can see actually for these people, retirement was actually almost like a second phase of their life, not an ending of their life, not a drawing down, taking the back seat. It was actually really moving powerfully into something they were looking forward to. So I really think that the perception of retirement being slowing down and not needing much money is totally wrong. The second sort of perception, you can say, or misconception in terms of retirement is to do with time. So many people, so we talked about the two problems that people face when looking forward and planning for their retirement. One is perception, the second is time. I've got a really interesting situation that's just happened, or you could say it's happening. I'm in the process of it. One of my golf buddies, he's 50, just been 50, and he said to me, George, I need to sort a pension out. Can you sort that out for me? He's doing very well. He's got a very good income, and he said, look, I'll put 10% of my income aside, into my pension. As I said, he's 50. His wife's a little bit younger than him. She's early 40s. They have two children, one that's 10, one that's 5. And so he's got 15 years. In fact, he even said to me, I want to retire when I'm 60, 10 years time. Okay, so just move on to the So the big question I said to him is, when do you spend your money? When do you spend your money? Do you spend your money when you're at work, when you're busy and you're active, or do you spend the money when you're not working, in the evening or over the weekend or whatever? And he said, when you thought about it, he said, yeah, he said, don't spend anything really when I'm at work. So I said to him, look, do you realise when you retire, you are going to need more money, not less money. You're going to have more opportunities to spend money rather than less opportunities to spend money. And he went, no, I didn't think about that. So I said, well, let's look at it. If you're putting, and we've got some figures shortly, many people underestimate the amount of time it takes to build a substantial retirement fund. You know, delaying the start of savings can have a significant limit on the ability to accumulate enough money to support you comfortably in retirement and give you the lifestyle that you want. Many individuals fail to accurately estimate the amount of money that they will need during their retirement. As I've just said to you, you spend the money when you're not working, not when you're working. The other, as I've said, and this also affects the state scheme, we've already seen life expectancies increasing, and it's always going to increase. Everything, you can think the energy of so many industries, of the pharmaceutical industry and the healthcare industry and whatever, the energies of part of it is certainly going into helping us live longer. This common sort of conception that retirement's going to be cheap, and on top of that, you've got the issue to do with healthcare costs, inflation. We've just seen a period of 12 months, and probably Somo will refer to that when he talks about the markets of inflation and the effects of inflation and what that can do. This sort of nicely leads on to, why have a consultant? Why do something? And when I was preparing for this and looking at this, I thought, actually, the truth of the matter is, and I was thinking back to the conversation I was having with this person I was talking about before, is number one, it forces the discipline. It actually gets you to look at the facts, to look at the reality. This one of the second reasons is it helps you in guidance to diversify. Obviously, in our situation, in GPI's situation, we work hand in hand with Mithril. But obviously diversifying, and number three, making the most of your money is so important. And number four, checks and balances. You need to constantly review what you're doing. You need to constantly see where you're going and how that matches with your life plan or where you want to go. The key to start investing as soon as you can and as much as you can. And we've got a chart following on from this that shows actually the difference of starting earlier to build up money for the future. And so, because it's a bit like pushing a snowball down a hill. Once it starts rolling, it's gathering snow all the time and getting bigger and bigger and bigger. And that's a little bit the same as savings and starting to invest when you're younger. And here is this calculation. And here we have sort of £10,000 invested at different ages, exactly the same growth rate. So at age 25, a person invests £10,000. By the time he's 65, that 10,000 on a 6% growth rate would have reached or would have grown to 102,850. We've done this in pounds. If he was 30, so 5 years later, and invested 10,000, it would actually be worth 76,860. If the person waited till he was 40, 15 years later, it would be actually less than, about 40% of what it was 15 years earlier, without him doing anything other than simply investing that one lump sum. Imagine the conversation I had with this chap who was 50, and he was sort of saying, it's about time I did something for my pension. Anything is better than nothing, but I felt like saying, you should have been doing this 20 odd years ago. Schroeder's Leslie Ann Morgan said, the fundamental principle of saving for retirement and making those savings last a lifetime are very similar, because that's what you've got to do, save for retirement and then make sure those savings for retirement last for the whole of your lifetime. Success depends on how much you contribute, when you do it, and obviously the way it is invested. We've illustrated this at 6%. So a little bit about us, and we're going to show a video about this. GPA Europe, we began in January 2018 here in Bratislava, obviously serving the European community from here, and we have an office or a situation in Zurich to look after our international clients. Let's play the video. So that's a little bit about us. We didn't want to sort of overdo it. And I want to introduce Somo, as I've said before, who's going to talk about Mithril, by way of about the market, should I say. As a bit of an introduction to Mithril, we've also done a video for that too. So here we go. Thank you very much. So what I'd like to do is hand over now to Somo, who's going to talk to you about what's happening in the markets. Over to you, Somo.
Thanks, George. Firstly, quick camera and microphone check. Is everything okay? Can you see me okay and all of that? Okay, all good. Yeah, thanks for inviting me to come along and talk a little bit about Mithril and about what we do, and then we'll move on to the current investment climate and where we go from here. So I had a presentation which is ready to kind of share. So now, do forgive me. This is my first time actually using this platform, so we will.
Yeah,
I'll do my absolute very best. Okay, that's great. Okay, so a lot of the kind of the corporate information about who we are and our beginnings and our journey, was painted very nicely in the video that we just saw. So whilst I'm sat in Somerset in the UK, we are of course headquartered in Mauritius, where I spend the majority of my time. I'm just passing through, visiting a little bit of family, and it is, believe it or not, actually quite sunny here in the UK, which is great. So there we go. Local advice, global expertise. I mean, it's a very kind of simple acronym that we have, but that is really what we do. I mean, hopefully from the promotional video, you'll see the sheer breadth of types of investing that we can do. One of the main mantras that we have at Mithril Asset Management is personalization and discretion. We've got hundreds and thousands of clients across the world, investing in a multitude of different ways. Whether they're investing in lump sum investments, or if they are indeed doing a regular savings plan, as described earlier on in the webinar. Regardless of the platform through which one is investing, we are able to create a bespoke investment strategy tailored to the requirements of our clients. Whether that is investing via collective investment schemes, whether it's in an all stock portfolio, whether it's in an all fixed income portfolio, structuring fixed income instruments, tailored for some of our institutional clients, and we also manage pension funds, on the side as well. So I'm going to kind of skip through. We've got three main topics that we want to go through. One is about us, which we've generally really covered. Okay, and then I'm going to go through the investment climate this year and where we go from here. So I'm not going to really dwell too much on the about us. Much of that has already been mentioned. Okay. Yeah, just a little bit about our mission, and really we work on a very long-term basis. You saw earlier on in the promotional video that we were set up in 2009 in Mauritius, and some of the clients that supported us on the day one of that journey are still our clients today. And in fact, our largest set of clients are still with us today. So we've been able to cultivate very long-term relationships with some very high net worth individuals, managing very, very tailored investment solutions for their long-term gains. Okay, these are the core values of the company. Of course, trust is a huge one, not just a trust company, but of course the trust that our clients place in ourselves. When you're investing, as George iterated, there is a degree of courage and bravery that you need trying to place your hard-earned and make decisions which are going to be for the benefit of a time period which may be very, very long down the line. So that takes a degree of bravery and courage as well. Openness, we like to be 100% transparent with our clients where we're investing and why. Response, of course, as George mentioned, is about constantly reviewing. One of the final points in his webinar was about constantly reviewing, and that is about response. And it's why you've got to have passion in what you're doing. Okay, and that is where the diversification aspect of what George was saying is very, very important, because you put all your eggs in one basket, then it can be a very, very different outcome, and not the outcome sometimes that you wanted to achieve when you first set out to do it. All right, so that's where having passion in what you do, trying to learn about where your money is invested, why it's invested in that way, and how it's structured as well. And to educate yourself as well a little bit on about how you invested, why, and where you're going to go on on that journey with a company like ourselves. Okay, so the investment climate, we get onto the nitty gritty for 2023. As has really been the norm for the last 3.5 years, it's been a bit of a seesaw affair. However, the second quarter of the year was actually extremely positive. Okay, with the advance led by the developed markets, most notably in the US, and I'll explain a little bit why later on. Okay, what we have been battling with post-COVID is inflation, and indeed the response to inflation, which is of course monetary policy, more precisely interest rates. We also had a second and indeed a third, which actually hasn't made it onto this slide, but is on the next slide, which was about investor caution, which is about the level of debt that is on the books of the United States and how they raised their debt ceiling in order to keep their public functions operating within the current administration. Now, to put that into perspective, pre-9/11, I'm going a little bit off the top of my head here. Pre-9/11, the US debt ceiling was around $5 trillion US dollars. It currently sits today about 33, right? So now I pick pre-9/11 as the kind of the start date. You know, we'd had the tech boom, we had a subsequent recovery, and then of course 9/11 happened, and of course major military intervention ensued after that. We then had the global financial crisis, and following on from that was another debt ceiling and a government shutdown predicament, which happened in 2011. And again, the plateau was rather smooth until we got to obviously the famous pandemic, of which then the debt ceiling and debt ceiling regulation had to be completely thrown out the window in order to keep the US economy afloat. All right. So to put that into perspective, right, 5 trillion of debt rather in 2000, in the year 2000, 2001 versus 33 odd trillion as at today. Okay, so that is something which I think that maybe you can think about conceptually about, well, what is actually money, you know, and whether, you know, debt management is indeed or the way in which the US is indeed managing its debt, or whether it can grow at a pace in which to service its debts if you can just keep on raising the ceiling of how much you can borrow whenever you get into a sticky situation. Okay. And the other point, which is on the next slide, but I'll mention it now, was of course the predicament in their own financial sector, which then spilled across to the European financial sector. So all in all, there's been a bit of a cauldron of different predicaments, which we've been very pleased to see have been responded to quite actively by the powers that be and by investors. Many of the gains have been achieved in the tech sector. Now, there are a lot of people here. We've all known about AI. AI has been documented in science fiction films for multiple decades and has found its way into popular culture, you know, and Hollywood, you know, in movies beyond. Okay, but now it's starting to become quite a casual part of our day. There are a number of different tasks now that we do in our day, which involves some form of AI. And now, of course, you've got applications on your phone where you can ask them anything, whether it's in a professional sense or whether indeed it's in a personal organization sense. There is a level of artificial intelligence which is now blatantly finding its way into our lives. And that has been something more of a social acceptance than rather than a technological advancement, because the AI has been there for a number of years. It's now just been socially accepted with the power of the technology which is within our pockets. Okay, so much of the gains that we've seen this year have, particularly in the US, have been attributed to the companies, the big tech companies, which are perceived to be the ones who can take the AI fever, okay, and take it to that next level. Okay, now whether that turns out to be a positive and a negative, I think depends on which side of the coin that you end up on from an employment perspective. But I think that from a casual perspective, from what I've been mentioning earlier on, I think that a lot of people have found it to be extremely useful. Somebody says, okay, you need to write a presentation or something on the investment climate in 2023. Then, of course, you can go into the US. Now, if you try and put that into ChatGPT as a caveat, it won't allow you to do it. Okay, so this presentation hasn't been at all written by AI at all. However, if you want to do something like, say, right, I want to write a general marketing presentation, or I need to know about the best way to write a formal letter or something like that. That kind of casual use of AI has now been socially accepted and is now finding its way more and more, and is now feeding into the minds of investors who are thinking, well, actually, there is something. The next big thing is actually here. And an AI is here to stay, for better or for worse, depending on where you sit. Now, the largest 7 companies in the United States are responsible for about 80% of US stock performance this year. Okay, so if you look at the NASDAQ and if you look at the S&P 500, the largest 7 companies generally comprise of some of the biggest technology companies on the planet, the biggest names that we use every single day: Microsoft, Apple, Amazon, Nvidia, Intel, all right? And those are the ones who have powered US stock markets this year, because, again, they are the ones who are going to take AI just from kind of like a social concept or something which improves your daily working life into something much more fundamental and much more transitory into the way we live our lives. Okay, and that fever kind of came in as we responded to the volatility around March and April, which is attributed generally to the state of the financial sector. Okay, we had 3 banking failures in the US, and then we had the big one, which was Credit Suisse in Europe. And the failure of Credit Suisse, I think, was an enormous shiver, given the size and the magnitude of the brand that it is, and its heritage in the global financial sector. From a US perspective, inflation, which is a major theme for now and for next year, has been seen as moderating in the US, to the extent where they have been able to pause their interest rate rise. Now, this is where the jury is out a little bit. Where do we go from here? Are they going to do another rate increase, or are they going to be able to pause again? The jury is very much out on that. Our personal house view is that we will see one more rate rise at the September meeting, and that will be it for the year. There are some people who say that there will be no further rate rises. There are some who say that there will be perhaps 2 more. Now, we don't think that there will be need for 2 more, because we certainly just do not see that inflation is spiking at a rate which needs the Federal Reserve to be that aggressive. Okay, and if we go into the next slide, we'll go into Europe, which we kind of think is roughly 2 quarters behind the United States in terms of its cycle. Again, the Eurozone posted gains in Q2, led by a rebound in its financials and, again, in the IT sector. Okay, financial sector shares rebounded from the failure of Credit Suisse, as I mentioned, in March 23, and a very, very swift takeover from its main rival, UBS. Right, ECB has raised interest rates twice in the past quarter, and taking its main refinancing rate to 4%. Okay, there was a mild recession over the winter. Okay, largely expected, and also largely attributed to what's happening in the geopolitical space. On a UK perspective, right, and I'll touch a little bit more on this because it's very, very important. Okay, UK equities fell. Now, the UK FTSE 100 is generally made up of a lot of oil and commodities firms, right? So when they experience a fall in the main index, and I think the figures as at today, I think we're roughly down about 4% for 1.4% year to date. Okay, it's because they have been impacted on commodities prices, in particular oil, for the year. Now, when the commodities prices start to decrease slightly, right? Commodities prices, energies prices, food prices as well, of course. They are the main drivers of inflation, right? And when those prices start to either spike or indeed fall, that will give you the first signal that inflation is peaking, right? Which means then, therefore, you will see a monetary policy response. Now, the monetary policy response, if your inflation is cooling or indeed is decreasing, means that you do not have to be as aggressive on the other end with your monetary policy and raising interest rates, right? Which means your cost of borrowing doesn't increase. That means your cost of living doesn't necessarily need to increase, which therefore increases your disposable income. Going back to what was illustrated earlier on in George's part. Okay. Now that doesn't mean to say that the fight is over, right? And the Bank of England has surprised its market, which was also a main driver for weakness in the FTSE 100 by surprising the rate in which it increased its interest rates, which is now at 5%. What the market was doing was it was expecting incremental rate rises of 0.25%. However, inflation in May came out so high that they had to do a shock 0.5 interest rate increase to bring it back under control. However, what you're seeing in the market, because the market moves slightly ahead of the economy, is that oil prices, energy prices, food prices are coming down, which means that the inflation numbers are going to start to cool, which will therefore then feed into what we think is going to be a greater normalization in the stock markets, which will focus on corporate numbers and less so on government policy. Okay, and then the last part is on Asia, and Asia is very fragmented. And I'll start with Japan. And the first point there is that Japanese yen weakness has created a fevered demand for its local stocks. So in Asia, the Japanese stock market has done extremely well, both on a local currency basis and on a currency adjusted basis. In order to stimulate the economy, the Japanese central bank has weakened the Japanese yen, and what that has done has created a lot of demand from foreign investors for their stocks, and that is something that they are looking to pursue. It's looking a little overheated there, okay, but what that will do is it will create opportunity elsewhere, and the main one is in Chinese equities. Chinese equities have performed lackluster and poorly for this year. Now, a lot of investors, ourselves included, were very, very positive on the Chinese stock market because it was opening post-COVID. Now, you know, we spoke a little bit about where we're all based. We're mainly in Europe, and we've all had our own experience with COVID and COVID lockdowns. Now, we had the big ones in kind of 2020, and then maybe spilled over into 2021. Now, in China, that spilled over into late last year, all right? So that's been a much more concentrated period of very, very heavy lockdowns. And now a lockdown in mainland China is not like a lockdown in Western Europe. It is extremely hardline and it is extremely regimented, and any failure to obey on the rules results in severe punishment. So when the Chinese market, the Chinese economy reopened post their latest pandemic, there was a lot of hope, excitement that we were going to see a period of large-scale economic growth and a real kind of rush for investors to go back into the market, whether it's in financial stocks or whether it's in property. We thought that there was going to be a multiplier effect with China as its nucleus, and the Chinese consumer as its nucleus more so. That didn't happen. And the reason that didn't happen was that the Chinese consumer was just simply battered from years and years of lockdowns and was just taking a mentality of hoarding their assets instead of going out and spending them. So, you know, the psychological factors that George was mentioning earlier on in his call, in the webinar, comes very, very much into play. And so after that kind of initial start, it started to peter out. Okay, and that is what has caused a lot of difficulty. Again, for the FTSE 100, an economy the size of China, which needs large amounts of oil, it needs large amounts of natural resources, and it needs large amounts of food to feed its economy. It just simply hasn't done it. All right. And then I have a point on India as well. And India has been, another one that's been able to achieve very strong gains. And again, with a relatively weak currency and solid earnings and solid bank balances on its major companies has allowed it to attract strong levels of foreign investment. So where do we go from here? Now, I've touched on quite a lot of it already. Okay, I've already touched on the peak in inflation. Okay, which is now first being illustrated by cooling in prices in oil, commodities, and food, the resulting reversal in policy, and then a pickup in Chinese growth. All right, and then we'll go into the last point, which is, of course, of the opportunities that we see. All right, peak inflation is in sight. Okay, and we definitely see that, and I've talked about that amply during the call. Yeah, US is leading the way in the Western world. Eurozone and the UK are approximately 6 months behind. Okay, yeah, the UK is probably in a worse state than its Eurozone counterparts, and has a much higher inflation rate. You're looking at about 8 to 9%, which is pretty high, versus about between 5 and 6 in the Eurozone. Okay. So US dollar remains overvalued, which could support the US markets. Okay. Now, what we're looking at here is a kind of an FX play, right? So if it's slightly overvalued, okay. Looking at my notes here. Okay. Okay. What we're then looking for is to support the US markets and then trigger greater investment into the overseas, most of all into China and the emerging markets, which I'll go on to later on in as an opportunity. Okay, so I mean, peak inflation again, from 9.1% 12 months earlier, we've got US inflation, which is now less than 5%. Where we've got a bit of a caveat there is the US labor market. It remains strong, and that can be a key factor in keeping inflation propped up. Where therefore, as we said before, we expect that one more hike is likely before the end of this year from a US perspective. Okay, which will then result in a policy reversal. Okay. With the US, I mean, the US has paused its rates. The Eurozone and the UK still have further to go, and I cannot see that there will be any rate cuts in 2023. And I think that it'll be more likely that we will start to see greater impetus to cut interest rates towards the end of Q1 in 2024. Again, that's been supported by what the ECB has said, that the inflation targets are not being met, but they are being progressed towards, but therefore it has room to maneuver. All right. Okay, so, and again, UK inflation targets have been revised upwards, all right, which is never a great sign. Okay, and that's why they have to be a bit more aggressive in their monetary policy. Now, when it comes to opportunities, I mean, we're always looking at China being like very much the growth engine of the global economy moving forward, and the primary driver for growth. Okay, and again, this is where a lot of the hope came in post-pandemic or post their pandemic, and it didn't really kind of peter out for reasons that I already mentioned. Okay, and their recovery has fallen way short of expectations. And as a result, we are expecting a raft of stimulus, easing of reserve requirements, so how much the banks need to hold back in order to keep their balance sheets solid and in line with the rules, which means that they can lend more, okay, and then consequently they will be able to benefit from a lifting of bank loan quotas, and then a generic cut in lending rates to attract more business, whether domestic or foreign, to prop up its economy. Right. So relatively speaking, I mean, we've gone through some of the inflation data earlier on in the call in different parts of the world. and comparatively speaking, China doesn't have anywhere near the same predicament. And then resulting in that, then we would start to see a broad support for prices and fuel prices within APAC, oil, commodities, and as well food prices, as an economy the size of China, with an enormous appetite for these types of resources, will then suddenly come back into the market and then develop even further. So a lot of the growth story really comes from that China nucleus, and again from beyond, and how they develop with their major trade partners, such as South Korea in the region, Thailand and Malaysia, which are big hubs for local Chinese tech subsidiaries, and and of course Taiwan, and which will then start to fuel into some of the themes that I mentioned earlier on in the call, to do with just general tech and of course AI. Okay, so generally in when it comes to the opportunities, I mean, I've mentioned the Far East, and we think that it's worthy of inclusion within any kind of globally allocated portfolio, diversification, as George mentioned, being key. The post-pandemic trade is still very much on. It's been a stuttered start, but the China entry points I think are very attractive at this level. Japanese yen to remain weak and prop up its local market, and the US dollar's weakening position, in contrast, may attract foreign inflows from investors diversifying away from Europe and the UK. We haven't mentioned much about the fixed income market, but they also look extremely attractive, and we would say that US investment grade bonds are looking attractive at current levels. And as the rates peak, which we feel that they are, and the inflation falls as a result, then yields could even match that of equities. From a European perspective, we don't think that it's there yet. And a final point, the China reopening trade to boost demand for oil and broad commodities, notably, oil, copper, iron ore, platinum and palladium as well were also good plays. So as the hunger for those commodities and natural resources returns, then therefore I think that deserves inclusion in any kind of globally allocated portfolio, over and above the vanilla allocation. You might go 60-40. You might be centric to the area which you're familiar with, be it the Eurozone. UK investors tend to be UK centric in that. We're very different in that respect. We're a globally influenced asset management firm, and believe firmly in the merits of diversification, and therefore inclusion of all asset classes within. Okay, so that is it for me. I hope you found it interesting and enlightening. Of course, the presentation is available to download or available via email for those who wish. So thanks very much.
Thank you, Somo. Thank you. So finally, really, we plan to go for about an hour. We're a few moments short. So pass it over to you all. Any questions from anyone? We've talked you into silence. Well, what we'll do is, for those who want to, as Somo's just mentioned, we'll send obviously the slides and the presentations, so you'll have that. Obviously, I really want to thank those people who have joined us. It's been our pleasure having you and sharing this with you, and wish you all a good evening. Take care. Good night.